Good evening, everybody, and welcome to Bajaj Finance's earnings call to discuss the first quarter results. To discuss the results, we have on the call Mr. Rajiv Jain, who's the Managing Director, Mr. Sandeep Jain, Chief Financial Officer, Mr. Rakesh Bhatt, Chief Operating Officer, Mr. Atul Jain, CEO Bajaj Housing Finance, and Mr. Anup Saha, President Consumer Business. May I request Mr. Rajiv Jain to take us through the financial highlights, subsequent to which we can open the floor for Q&A session. Over to you, sir.
Yeah. Thank you, Karan. Good evening to all of you. Our apologies for starting this late in the evening due to the annual general meeting of both Bajaj Finance in the afternoon and Bajaj Finserv in the late in the afternoon. I have some of my colleagues around the table that Karan has already introduced. We have uploaded the investor presentation deck on the website, and we will refer to that for the purpose of this investor call. I will request you to jump straight to section 1 of the investor presentation and page 13. Given that these are all financial numbers and given the transition from previous GAAP to Ind-AS, and this is the first quarter that we are publishing these financials, we have provided previous GAAP data, which is section 1, and then we have provided Ind-AS financials, which is section 2. And given that they're all essentially numbers, I'm going to request Sandeep Jain to slowly go through section 1 and section 2. He'll first go through previous GAAP, then go through Ind-AS, and I will come in at section 3, which is about non-financial commentary and some of the important slides. And then we are ready to take questions.
Yeah. Sure. I'm on slide number 14. Before I start talking about the numbers based on Indian GAAP, which is not the standard that we incrementally will follow from reporting perspective, let me just read out the disclaimer. This is the first time that you're adopting Indian accounting standard, and in order to facilitate comparability of numbers, in order to ensure that you understand the performance of the company in the way you used to see earlier as well, we have basically worked out the Indian GAAP numbers as well, basically to give you the view of the core growth that the company has delivered in the last quarter. These are not the numbers that have been reviewed or have been subjected to review by statutory auditors. In the quarter 1, as we close quarter 1, which is on 30 June 2018, we have seen 30% growth in our customer franchise. The customer franchise came in at 28.28 million as at end of 30 June 2018, which is up 30% from 21.69 million that we had last year same time. We had very good traction in terms of acquiring new customers. We added 2.07 million customers in the current quarter. New loans booked, of course, we did record 5.63 million customers in the current quarter, which was 49% higher than what we acquired in the last year same time. Assets under management, of course, this does not get impacted by Ind-AS in any given manner, came in at 93,197 crores, up from 68,883 crores, which was a growth of 35%. Now, last year, if you remember, we had IPO financing book, which typically is a 3 to 4 days financing that we do, which was about 2,000 crores. Adjusted for that, the asset under management actually grew by 39%. Total income came in very strong at 37% at 4,276 crores for the quarter. The interest income came in at 42% thanks to the fact that the cost of fund also came in at 30 basis points lower than where we used to be in last quarter same time. It came in at 2,904 crores for the quarter. Loan losses and provisions for the quarter 1 came in at 284 crores, exactly in line with what we had seen in the previous year of 282 crores. Virtually no increase in loan losses, despite the 35% asset growth that we have seen in 1 year time. Profit after tax as a result, which is core profit, let me call it core because this is based on previous GAAP that we are used to seeing, came in 69% higher at 1,018 crores for the quarter versus 602 crores that we delivered in the last year same time. Consolidated GNPA and NNPA, of course, there is no change in the definition of gross non-performing assets as we transition into Ind-AS. Came in at 139 basis points versus 170 basis points that we saw in the last year. because of expected credit loss provisioning that we are required to do, that you will observe as we progress from here and move to Ind-AS, that there is some change that has happened in net non-performing asset. The number as per Ind-AS, if you were to as per Indian GAAP, if you were to calculate, came in at 37 basis point. We had a provisioning coverage, assuming that we pursued previous GAAP for the current quarter as well, came in at 74% as at the quarter end. Return on assets and return on equity remained very solid at 1.2% and 6% non-analyzed basis, respectively. Let me jump to slide number 15, which is the very critical slide from this call perspective. This slide essentially gives a reconciliation of the impact that Ind-AS has caused on the financial performance of the financial results of the company. Let me talk about the format of this slide before I get into detail. The first column basically highlights what kind of changes have happened because of Ind-AS migration. Then you have four columns, which are basically Q1 current year, Q1 previous year, a few items where growth have been explained, and FY17-18 as recasted based on Ind-AS financials. And of course, the remark is self-explanatory in that sense. Profit before tax for Q1 2019 came in at 1,562 crores as per Indian GAAP. There are certain adjustments that have happened or come in because of Ind-AS. The largest being amortization of processing fees, the subvention, and the cost of acquisition over the tenure of the loan. That had an impact of 221 crores on profit.
The net number.
This is net. So this number is net. So you will have a larger number when you do calculation at upfront fees and interest subsidy level. And there is a benefit that comes in because of amortization of expenses that is also allowed under Ind-AS. The net number is 221 crores. Similar to amortization of revenue and cost in loan book, Ind-AS also permits to amortize the cost of raising deposits or borrowing that we raise in the market. That gave us a benefit of 8 crores for the quarter. Expected credit loss is a new way of accounting for losses as defined in Indian accounting standard. It essentially harps around the fact that one should not follow a particular metric or a particular percentage in terms of determining what losses would hit in the P&L. Every company is different, every financials are different, and hence every company needs to create its own metric to determine the expected credit loss. The definition is basically
by auditors.
Yeah, and of course to be signed off by the auditors. It basically talks about the probability of default, which means if I have 100 customers sitting today, all current, how many of them would move into delinquency over a period of time? And there are definitions around 12 months provisioning as well as lifetime provisioning. I will come to it. Second is EAD, the exposure at default, which means a customer who has an exposure of 100 rupees today, when the customer actually will go into losses, will he go with 100 rupees outstanding or 110 rupees or 90 rupees outstanding? That's expected exposure at default. The last important metric is loss given default, that if the customer goes into loss, what kind of recovery company would be able to make and what is the ultimate loss that the company will incur. All discounted at present value. There's a significant amount of complication that comes in because of that. Now, based on the historical empirical data that we have seen at portfolio by portfolio, we have created a very comprehensive expected credit loss model for the company. That through, by line of business, that has through a number of 37 crores of higher provisioning. I would like to call out that if I were to differentiate between provisioning on non-performing assets versus provisioning on standard assets, the provisioning on non-performing assets have generally gone down as we have moved to expected credit loss model, whereas the provisioning on standard assets, because now we are required to make provisioning on a lifetime, for example, for a 12-month loan product, which is consumer electronic, digital products and so on and so forth, anything less than 12 months, there we are provided for lifetime. And also for other products where the customer has moved into 1 EMI and 2 EMI default, we have gone ahead and made a lifetime provisioning. As a result, the standard asset provisioning on the portfolio has moved significantly from 40 basis point to 90 basis point approximately. That has resulted in effective hit of 37 crores for the quarter. Apart from that, of course, there is fair valuation of ESOP options, etc., which we were doing earlier also, but it was not required to be put in the P&L. Ind-AS requires you to put it through the P&L. The rest of the numbers are smaller in terms of impact. The profit number for the quarter, instead of 1,562 crores pre-tax, as a result of Ind-AS transition, came in at 1,297 crores. Post-tax came in at 836 versus 118 crores. That would have been the number based on Indian GAAP. FY18 number, as we recast, the 4,096 crores of pre-tax or 2,674 crores of post-tax came in at 6.5% lower on a full year basis as we recasted the financial or Ind-AS. So that's the movement that we have seen on account of migration to Ind-AS. Interesting thing, if you notice the numbers, the significant amount of impact that you see in 2018 has actually got accounted in first quarter of last year itself. So we have not seen an incremental flow through of Ind-AS impact going in the balance part of the year.
Likely to be the case in the current
which is likely to be the case, of course, in current year as we progress. Of course, given that we are also very new to Ind-AS, it's very difficult to put pen on the paper and project Ind-AS numbers. But looking at the last year's trend, all goes well, we should see similar kind of performance. Let's quickly move to section 2, which is Ind-AS financial performance for the quarter. I'll not be picking up all numbers. Let me talk about numbers which have changed on account of Ind-AS transition. Net interest income, as on account of Ind-AS transition, has moved up to 46% growth at 2,578 crores, taking into consideration amortization of revenue and cost pertaining to the asset side as well as liability side of the balance sheet. Loan losses versus 284 crores in Indian GAAP for the quarter one actually worked out to 327 crores under Ind-AS model. As we recast last year number, the growth in the loan loss number was merely 5% versus a balance sheet growth of 35%. Profit after tax came in at a record 81% for the quarter, 836 crores. Apart from that, as I mentioned, the gross NPA and net NPA, the definition for gross NPA has not changed, so the number remains at 139 basis point as per Indian GAAP also, and as the case in Ind-AS. However, the net NPA, because of provisioning standard change, has increased from what we would have reported in Indian GAAP of 37 basis point, and actually came in at 44 basis point in Indian accounting standard. So that's only 767 basis point movement in net NPA. Deposit book came in very healthy at 9,427 crores, which was a growth of 85%, which was actually at 14% of the overall standard borrowing that we had in the company. Very happy to announce that company has again been ranked as one of the best companies to work in India by Great Place to Work. This was the 6th year in a row that we have been recognized with this kind of ranking. A similar statement in terms of now let me move to slide number 18, which is basically consolidated profit and loss statement for quarter 1 2019. We have tried and covered, given that this is first time that we are seeing Ind-AS financials, a detailed commentary in terms of how one should look at the variances in the financials. All the numbers that you see here are recasted even for last year based on Indian accounting standard. Total interest income and fee income came in 39% higher at 3,941 crores. Very strong traction that we have seen in fee revenue pool across the insurance business that we do, distribution that we do for CTV products, and so on and so forth. Similarly, on account of amortization of costs related to acquisition, the number came in very strong. Interest costs saw only 27% growth on account of two reasons. One, of course, we raised capital in September last year, so that's the benefit of additional capital sitting there. Plus also the cost of fund has also come down by 30 basis points. Additionally, Ind-AS has provided a 8 crores breather in the quarter. The interest margin as a result came in at 46% higher. Operating expense was a big surprise, came in at 28%. We have seen a significant operating leverage across most of the businesses in the company. That's one. Secondly, last year, same time, we had incurred some one-time expenses of anywhere between about 25 to 30 crores towards advertisement, other initiatives that we had taken. Plus, of course, the point that Rajiv keeps on mentioning about the prudent OPEX management, I think, has really played out well in the company. That has again given us benefit on operating expenses. And the last point is, which is most important, as we transition our business of mortgage into housing finance company, Rajiv did mention in the previous quarter that we have pruned about 50 crore rupees of cost in the business while transferring it to the housing finance company. This is not left pocket, right pocket that the cost has been retained in Bajaj Finance. These are costs which have been completely taken out from the company. So that is also sitting in terms of operating expense benefit. Just to clarify, that 50 crore number is annualized number. Loan loss provision came in at 7%, as I explained. As a result, of course, the growth is 11%. Loan losses to AUM came in at record low of 35 basis points for the quarter. Last year, same time was 44 basis points. Another important point I think all of you will have in your minds is basically what kind of impact did Ind-AS cause when we transition into the new reporting standard. We have given a reconciliation of opening reserves and surplus as of 1st of April 2017. While the reporting starts from 1st of April 2018, the transition date as per Ind-AS rules is 1st of April 2017, which is previous year. Opening reserve as on 1st of April 2017 or 31st of March 2017 was 9,491 crores. The items that I explained for Q1 variances appear here as well. Adoption of effective interest rate method for accounting of income on lending balance sheet gave an impact of 797 crores as a one-time impact as on 1st of April 2017. Again, on the borrowing side, we have seen 79 crores of impact, positive this time because we are in the process of amortizing the cost of raising of deposit as well and borrowings. That 71 crores benefit came in. Expected credit loss, mainly on account of additional provision required on standard assets, gave a negative impact on reserve of 270 crores. Valuation of financial assets, which is fair valuation through P&L, came in, gave 46 crores of benefit in the P&L. The important point that is to note here is even after migration to Ind-AS, the dilution in the reserve is hardly 5-6%. And the most important point to note is, I think with the movement of Ind-AS and the expected credit loss, while we were very clear that the provisioning standard that we were following for loan losses was ensuring that the P&L is fully costed, ECL is actually ensuring that not only the P&L is fully costed, even the balance sheet is fully costed for, provided for the potential losses that can come in or emerge from the business that we do. Slide number 20, and after that I'll hand over to Rajiv, is basically to give you a view as to if you were to report the last year financials on a quarterly basis as per Ind-AS, how the trend line would change. The left block is basically the previous gap reporting on a quarter-on-quarter basis. You see cyclicality is playing out. 602 crores in Q1 going down to 559, going up to 768, and again going down to 745 as we go towards Q4. In the Ind-AS regime, what will happen is because the expenses and upfront revenue, etc., is getting amortized over the tenure of the loan, you see a pattern emerging in terms of performance of the company. 461 gradually goes up every quarter and reaches 748 crores as we sign off the year. That's what I had to share on financials. I request Rajiv to take section 3.
Thanks, Sandeep. I'll quickly jump to page 22 or to non-financial commentary. Overall, I mean, the first line is an important line that it's one of the strongest start of our first quarter in the last few years. And as actually one of our vice chairmen says that if you start your first quarter well, in general you'll end up ending well because it's AR-based businesses, it earns money through the year. So I think to that extent, it's a pretty strong start. BHFL fully operational, progressing well in terms of the transition that we had planned, and we are quite confident and comfortable that business will deliver good growth as they build the model out from third to fourth quarter onwards. BFL continue to focus on a standalone basis on the granularity of portfolio across products and geographies with the objective of clearly reducing risk and augmenting profitability. I think that journey, even in Q1, just continued. It's one of the reasons it reflected in better margin profile, lower costs in general as the economics, as our investments play out, and better risk matrix. Clearly, if you reach these customers and you're efficient in the way you manage it, they are higher margin and lower loss. To focus on to deliver the granularity, clearly you need to continue to grow distribution. We opened 150 odd locations between rural and urban to 1,486 locations. OPEX to NIM, Sandeep mentioned it. It is a little bit of surprise to us as well, so that we are all on the same page. We did tighten the screws on NIM, on OPEX expansion in November 2017. We put out hiring freeze and so on and so forth in certain parts of the businesses. Didn't expect that it will play out this well. So we are quite pleased with it, but not taking it. I would just request that that's not the number going in. We continue to do the right thing. You accelerate, you decelerate, you accelerate, you decelerate. That's really how real businesses are run. So the real number would continue to be, as I've said, articulated in the past, that the number should be around 40%. That's really what should be expected from a OPEX to NIM standpoint. But at one level, it demonstrates that it's possible. Now this quickly is a surprise even to us, but it is possible. It is a lever that is available in the business to manage business well. ALM continue to be judiciously managed. That's why, despite the hardening in the bond markets, hardening in banks, liquidity not being tight, I think it has had no impact in Q1. Clearly, micro is strong, macro is weak, hardening interest rates is a reality. We will see 2 to 3, maybe even higher rate hikes as GST inflation also plays through the economy. So clearly, we're in for a higher interest rate environment, which on a transient basis will mean margin compression. It's not played through in Q1, not likely to play in Q2, but maybe from Q3 to Q4. By Q3, Q4, you may see some impact on margin compression play through the P&L. Portfolio quality remained very, very strong. Q4 was very strong. If you refer through to the slides where you talked about slide 26, 27, and we are now giving 9-quarter data. Actually, if you do corresponding same time last year and the year before, in most of the businesses, if not all, we were actually coming in better than where even we were last year and 2 years ago. So I think, and that's what is reflecting in the 7% loan loss growth in Ind-AS, and in previous gap only 1%. So we are in a pretty strong position there. MobiKwik wallet, we invested 225 crores last year, 2.2 million active customers, 3 million have downloaded, 2.2 million are active, and we continue to work to mobilize our entire wallet strategy. Point that is probably not here, should have been here, is that the credit card business continues to move well. The company crossed 500,000 credit cards in force and came in at 508,000 Bajaj Finance RBL credit cards ending June 30th. The board of directors of the company today approved us creating another subsidiary, which will be Bajaj Financial Securities. The strategy clearly of that company is, as some of you are aware, that we are among the top 2 loans against securities lenders in India, to ring-fence our clients and to offer the same clients demat and broking services to start with, and augment in the process the profit pool of the last business. We have received approval from the board to have a separate securities company which will offer demat and broking to its captive customers. So that's a broad non-financial commentary. Slide 23, very quickly. Franchise continues to grow well. 2 million new customers in the quarter, 28 million overall franchise, 16.5 million best customers, added 1.1 million customers. Slide 24, as I said, 153 new locations got added, 1,486 locations that we are now in business in. These are not branches, these are locations. and 70,000 points of sale that we now cover versus 64,500 points of sale in March 18. Slide 25, growth was pretty granular in nature. Consumer B2B grew 27, B2C grew 47, rural 75, SME 42. SME was a big comeback. We've talked about fourth quarter it grew 19%, the year quarter prior 16%, the quarter prior 15%. So clearly post GST, the flow is stronger. As you can see in the later slides, that the performance is also turned around from a credit standpoint. If it's sustained for a quarter or so, I would say we are probably out of the woods and into a strong growth momentum that we used to be pre-demon. Commercial lending, you see a number of 32. There's an asterisk there because there's an IPO financing business this quarter and sitting there. Otherwise, the core growth was around 69%. Mortgages at 27% as the mortgage, as BHFL gets its arms around the business more strongly, by third or the fourth quarter, you should see much stronger growth. The next 26 and 27 slides are data on our portfolio quality. We remain in the business of risk. You see, I will focus just on the color. So other than the two-wheeler business, most businesses are better than last year or the year before. Other than the two-wheeler is better than where it was in quarter 3 and quarter 4, but still behind where it was 2 years ago. 2 years ago, their current portfolio was 89.5. They're still at 87.6. So there's some still work to do there. Slide 29, very quickly. This is provisioning coverage under Ind-AS by lines of businesses. B2B, overall company is 1.39% and 44 basis points. I won't go through the numbers, but you see the higher risk businesses and lower risk businesses. So mortgage at 56 basis points and 22 basis points, whereas you can have consumer B2B at 2.73% and 89 basis points. And we continue to be highly prudent in the way we provision for them. Last slide, slide 30, and with that we'll open it up for questions. Assets have grown to 93,000 crore. Overall, opening GNPA came in at 1164, lower than March 18. Slippages were 379 crores. Rollbacks were 263, and net addition to the gross NP in the process was 116 crore. So clearly, if the micro improves, you should see movement here. That's the other way to really look at this. And gross NP in the process came in at 280 crores. So if the micro improves, you should see some momentum. We say we are efficient, but if the consumer gets better, we will see greater momentum here. With that, we open it up for questions. I have my colleagues and myself here to respond. My apologies for a little longish opening remarks, but given the transition to Ind-AS, we thought it's important that we go slowly and spend time on providing you detailed update. We are open for questions, Karan.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. The first question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Hi, Rajiv, and congrats for a great set of numbers. Just 1 or 2 questions from my side. You mentioned that standard asset provisions or standard asset provisions equivalent under the ECL would work out around 89 odd basis points. So if maybe you could just explain what it is and how would it change over time, whenever the greens turn amber, etc.
Yeah. So basically, ECL requires, as I mentioned, to make provision based on estimated loss rather than a particular percentage prescribed in the rules and regulations. As we make provisioning in ECL, ECL has defined 3 stages: stage 1, stage 2, stage 3. Stage 1 essentially set of customers who are current, who don't have any default. Stage 2 is our set of customers where customer has 1 or 2 installment overdue. They have still not slipped into NPA bucket. And stage 3 is nothing but NPA accounts more than equal to 3 installment overdue. In case of standard assets, is bucket 0 for a moment, which is stage 1. The ECL requires you to make a provision on 12 months forward basis, which means you make a projection as to how many customers will default in 12 months' time. As a result, what kind of lifetime losses that they can give to the company.
Based on empirical data.
Based on empirical data. That's one way of providing it. That's where the number is probably 45, 50, 60 basis points. The second set, which is bucket 1 and bucket 2, installment 1 outstanding, 1 or 2 installment outstanding, there the ECL requires you to make a provision on a lifetime basis, which means on the date when a customer moves into bucket 1 or 1 installment overdue, you have to provide for lifetime losses. And hence the number moved significantly from 40 basis point, which was regulatory requirement, to almost 18 and 90 basis point, which was an outcome, based on the product level working that we did on expected credit loss. The most important thing to focus on is the credit portfolio quality, which is given on slide 26, 27, 28, where most of the business, if not all, have improved in terms of portfolio quality. Their current bucket performance has gone up.
No, but if they were to deteriorate, you would see ECL play in and stage 2 requiring higher provisions. So what used to be happening at 90 days past due will now start to happen at stage 2. Which is, so account is not even delinquent and it'll require you to provision. So
I think one more point that you can note is last year, if you see Q1 showed a 13 crores impact on account of migration to ECL. By the end of the year, financial year 2018, the impact came in positive 9 crores. So depending on the portfolio composition, of course, the numbers can move.
So any sense you could give as to, some sensitivity around, when the green turns amber or amber turns red, what could be, how this number could move like?
So I think one will have to create his or her own model to figure out the impact. ECL is a new way of looking at provisioning. It will be difficult at this point to comment on it, but as we progress on the journey of Ind-AS, maybe over Q2 and Q3, we'll have more clarity that we can share.
Sure. Just one point was, the other point was on basically expenses. You mentioned that you got a 50 crore benefit during, because of the transfer of book to a different company. I didn't quite...
No. We restructured the mortgage business and took out 3 to 4 crores of costs per month. Is the point. That's why I was correcting Sandeep that 50 crores is the annualized cost save as a result of transitioning because you got to run a standalone pure play mortgage business. As long as it was sitting in the large umbrella of high margin standalone BFL, it could support, sustain and pay for it. As that business moved to, so prior to moving the business, we restructured the business and then transitioned it into BHFL. That's the point Sandeep was making. And in addition, the point that 2 more points that were being made, one of them I made, that we did tighten our operating expense orientation in November. We had a freeze in the company for a 5-6 month period on non-branch headcount, and there was an advertising campaign that we ran last year, which were booked. So all this totaled up to the overall operating leverage decision that came through in Q1.
Just one last data point. If you have, I'm not sure if you shared this, the net worth as on March 18.
We have not shared specific numbers, Nishint, but the impact on March 17 was, of 1st April 2017, was 612 crores post-tax. The impact that has been shared on slide number, let me just, 1 second. That's on slide number 15 is basically 2,674 crores of profit as per Indian GAAP for last year, getting recasted to 2,496. Some of these 2 numbers, I think 780 to 800 crores is the impact that one would see on reserves and surplus as of 31st March 2018.
That's correct.
Okay. And can you share the June 18 number? Or I can just do the math.
June 18 is additional 200 crores impact.
Okay.
170 crores.
Great. Thank you very much and all the best.
Thank you. The next question is from the line of Agastya Dave from CAO Capital. Please go ahead.
Thank you for the opportunity, sir. Congratulations, and thank you very much for your hard work. Sir, I wanted to understand a bit more about the underlying assumptions when we calculate through the Ind-AS route. First is what... Sorry?
Go ahead.
Yeah, first is the discount rate that you use. If you could share that. I mean, what are we talking about here? How much is the discount rate?
Discount rate is product by product. Yeah, please finish the question.
Yeah, the second is, if you look at your entire portfolio, including the subsidiary now, the mortgage business, in that entire portfolio, what would be the loss given default? What is that assumption? That in case a default happens, what kind of loss, I mean, what is the underlying assumption there? What are you taking? And in these two questions, the discount rate and the loss given default, what is your expectation in terms of the trend going forward? I mean, what will happen with, let's say, if there is a systemic problem, let's say, and defaults rise throughout the industry, these numbers go up by how much? What kind of, given calculations that you have done, what kind of additional cushion do you have with respect to what really will play out? The third part of this question is that your standard asset provisioning has gone from 40 to 89. Now, this additional 49, what is the regulatory treatment for this? I mean, will your regulatory calculations be done on a different set of accounts, or will it be on these numbers only, and will it be considered as T1 or will it be T2? What's the impact there? And finally, on Ind-AS, in one of the slides, I forget which one, you have mentioned the number 797 crores. So that is the net pool outstanding of unamortized fees. Is my understanding correct, sir?
Yeah. So let me go point by point.
Yeah.
You asked first question about discount rate. Discount rate is not used at company level. It's used at product level. The internal rate of return in that particular loan, let's say if I take an example of consumer durable loan, if we do the business at 24% IRR, 24% is used as discount rate. If you're talking about home loan, which is done at 8.5% IRR, 8.5% is used as discount rate. That's how it has been. That's how it is done. In case of loss given default, we have used empirical data, product by product. Again, it's not a broad brush that you can use one LGD loss given default at company level. Again, there are nuances at product level that one has to go through. It may be different for a consumer electronic product to a two-wheeler lending to a home loan product. I may have a scenario where home loan product may give a LGD of 10% or 15%, which means the ultimate loss that I'll have on the customer may be only 15% of the amount that was outstanding in the customer into default, versus a consumer durable loan or two-wheeler loan, which can have LGD to the tune of 80% also, which means the customer, when it will default with a 25,000 rupees outstanding, I may be able to recover only 5,000 rupees from the customer, and the customer goes actually into losses. So it's again being done at product level, not at a holistic level.
Basically, if we run 25 different lines of businesses, that's 25 different models that have been created, and that comes to the last point, that what is the impact? The impact is not going to be impact on the company, will be an outcome, and more granular the portfolio and more distributed the business, less will be the impact in general. Yeah. But otherwise...
Yeah, so that was the question here. As granularity increases, that gets captured, right?
Of course it gets captured, yes. Of course it gets captured.
Now, on your question on regulatory reporting and how this provisioning on standard assets, which are loans which have 0 to 2 EMIs outstanding, given in the absence of any clarification from RBI at this point in time and the way the current prudential norms read, all the provisioning made on these customers have been taken as Tier 2 capital for the purpose of capital calculation. Other than that, there is no change. Any which is the cost has to go into the P&L. That's what has been done. The one-time impact as on 31st of March 2017 has gone into reserves. So that's a transitional provision that has been given in that as well. Your last question was on 797 crores of amount, which is in the reconciliation of opening reserve that we have given. You are right. That's the unamortized portion of the upfront fees, subvention, and the cost that we have incurred for acquiring those customers. That is sitting on 31st of March 2017. It's a net number. It has gone up by 197 crores in 2018. It has gone up further by 221 crores in current quarter of this year.
Which is the point that Sandeep was making, that in general, because as he shared on slide number
15.
Slide number 20, that we see the impact of it play in the first quarter on a full year basis. So that's really how you connect that dot.
So will this number continue to diverge, or will it become a constant number which will not grow? I mean, probably it rises to, let's say, 2 years down the line, it rises to 2,000 crores and then stays stable at 2,000 crores? Or will it be like vanishing over a period of time?
If we continue to grow well, and which we have aspiration of growing well, and if we keep the portfolio mix the way it is today, the number will keep going up. However, if there's a drastic change in the portfolio mix wherein a particular product has a very small amount of processing fees that we collect from the customer, then you'll see that this number can probably go down as well.
So if the mix doesn't move, this won't move. But so our view on the business may not change, but just the mix may change as a result of external environment or internal view. This could change.
So, or multiple variables. So if we reduce the processing fees that we charge to the customers or increase the cost of acquisition, of course, then this number can, for that reason, also can go down.
Structural change that one doesn't want to make that change for the sake of accounting. So, yeah.
Okay. Final question, sir. Great operating leverage again on the P&L. But how much leverage how much operating leverage is just too much? I mean, is there an upper limit of dollar NII that you can generate per employee? At what level do we start seeing again a bit of catch-up happening on YOY changes?
Given the strong growth, we are not as I said, we did put a freeze in November. It's more from a culture orientation standpoint rather than cost. With a profit growth like this, we don't need it. Okay, but we were the ones as a management 2 years for the last 2 years, we were saying, let's build out the talent, technology, let's invest. There comes a moment where you say more from messaging and less from the company has to change course. Management is aligned to it, or the senior management on this table is aligned to it. But the company can start to behave in a particular way. So it is more messaging and to make sure that we just optimize. That's the right word. Let's just optimize, and but the company responds very well in general. That's really the culture of the company, and it responded very well. As I said in my conversation, in my remarks, that I didn't expect the company to respond so well. It is not like people need people and they are not getting people. Or we expanded 153 branches, right? That means on an average we added 8 to 9 people are in each branch, which means we still added 1,200 odd people. So it's just optimization rather than anything else. But it's played to us as well that it can be a lever. It can be a lever.
Till what AUM will this be a decreasing function?
Okay, I'll simplify the conversation. 40% is the rightful number that you should hold at. As I keep saying, to anything better than that, it came into the profit pool. It could be in a quarter 42. We just want to make sure that everybody knows that we are prudent in watching the line. We have reached a point. The only point I would make, and some investors in the past have asked me, that we've reached the size of the bubble is now large enough to optimize. So is that correct? Yes. So we'll keep accelerating, optimizing this line, because it can mean operating leverage and profitability movement can be large. So that's
you said 40, right, sir? You said 40, 40?
40. That's correct.
Thank you very much, sir. Good luck, sir. Good luck. Thank you very much, sir.
Thank you very much.
Thank you. The next question is from the line of Ashi Anand from Allegro Capital. Please go ahead.
Yes, thank you for the opportunity. I had a few questions on just trying to understand the whole EIR impact a bit more. And if I'm assuming that the larger part of the EIR impact is because of amortization of upfront fees, I was just trying to understand what would cause the seasonality where the larger hit is actually coming in Q1, because I'm assuming upfront fees actually accrue over the entire year.
The current Indian GAAP allows the processing fees and subvention and cost to be accounted upfront. If we take an example, let's say of consumer electronic loan, we finance it today for 25,000 rupees. We get a subvention of 2,000 rupees, for example, on this. This 2,000 rupees currently accounted or was being accounted upfront on the date of receipt. Under Ind-AS, this 2,000 rupees has to get amortized over the 8 or 9 months tenure of the loan, which is nothing but EIR-based accounting. As we do that, and the fact that Q1 sees more number of televisions and electronic products and washing machine and air conditioners being sold, you see the upfront revenue pool contribution go up significantly. As we move to EIR, this upfront has to be amortized and hence bigger impact in Q1.
So, Yeah.
Sure, but would it be fair to say that the share of consumer durables is that much higher in Q1? Because even if I'm just looking at EIR, it's almost like 90-95% of the EIR impact coming through in Q1. So just trying to understand, would it be fair to assume last year's trend to also continue this year? And is that how seasonal the business really is?
That's correct. The seasonality is very high in consumer electronic business.
First and the third quarter.
First quarter and Q3.
First quarter over the last 3 years is larger than
even Q3.
Q3. Yeah.
So there is one season which is summer where lots of ACs and refrigerators are sold. Second season is Diwali where lots of festival buying happens. So the number moves up significantly.
Okay, excellent. And if I'm just trying to understand the impact of this from, say, a longer term period, as long as our growth is very strong, so our share of new kind of loans where we're having to be having to kind of, instead of taking upfront fee income in one quarter, we're taking it across the term of the loan. But we're also getting a benefit on the older loans where we're actually getting the amortization of the older.
That's correct.
Right, so we're really looking at that business mix, right? So as long as we're growing very rapidly, this is negative, but see if growth actually comes off, this could actually move to a positive impact. Would that be right to understand?
Only one clarification. When you're comparing with Indian GAAP and Ind-AS, you call it negative. But every growth has positive impact on the balance sheet and P&L over a long period.
So that he understands. He's asking that's correct. See, fundamentally, you are in a way, if I could simplify it, that are you off the treadmill in the process that earn today and book today versus earn today and booked over a period of 10 months? Yes. So clearly, as one of the points that Sandeep also mentioned, that not only does it strengthen the P&L, so we think Ind-AS is the right thing to happen. We were waiting, we thought IFRS would come in and it would allow us to do this transition. So clearly it's a right thing to happen. It will make the business much more stronger.
Okay, perfect. Thanks a lot for the clarifications and all the best for the future.
Thank you.
Thank you. The next question is from the line of Hiral Desai from Anivet Portfolio Management Services. Please go ahead.
Hi Rajiv, hi Sandeep. Just wanted this clarification on the EIR for Q1. Out of this 221 crores, how much of that is impacted because of, let's say, short cycle products like consumer durables?
Hiral, only one point. If you look at last year numbers, right? Last year number, as I mentioned, Q1 impact last year was 186 crores. Full year impact is 197 crores. Looking at these numbers, I have reason to believe, and that's the reality as well, that a significant impact of 221 crore is on account of shorter loans, which is consumer electronic, digital products, and so on and so forth.
Okay.
And it will get even more as we walk through the year.
Just one more clarification. This 797 number that you have for FY17 reserves getting adjusted. So if, let's say, the FY18 number is negative 200 crores, that reserve number or the negative impact will go up by 200 crores, is it?
Correct. That's correct. But don't look at 797 or 221 in isolation. Look at the total impact. So you have to also count...
Sandeep, there will be some rundown of the book also, right? Given that, these are largely 6 to 9 month kind of loans. I'm just trying to understand why is the number successively then going up? Because, if it was a pool as of FY17, there would have been a decent rundown in FY18 also, right, on the consumer durable book.
Correct. So
it's a very fast churning book, right?
That's correct. So 797 crores as of 31st of March 2017 would have completely got recognized in 2018. But because we have also done business in the last year, 797 plus 180 crores has moved into unrecognized income as on 31st of March 2018. So the number has flown into the P&L, but whatever business we have done in the last year has again created a unrecognized revenue pools.
So if we had not grown, so the fact is B2B consumer business, which is most of it is that is 27. As part of rural, there is a block that is sitting there. To the point that Sandeep is making, you are emptying the bucket from the past, but you are filling up the bucket. If you are growing the business, there is not a problem. If you are not growing, what it will help the management at one level is that you will still see smooth P&L, but at the end of it, there is no money in the pot.
So Rajiv, my question was, if you are emptying the bucket at the end of the year and the flow through of the P&L for that year is only
emptying the bucket, the unrecognized revenue of 31st March 2017 will run down over its course, which is based on the loan maturities and how the income will get accrued as per EIR. It's a normal amortization. Based on which, I'm just giving example that if you assume that 797 is entirely on account of short-term loans that we have done of 12 months. Everything would have got recognized, but I would have created a new pool of unrecognized income as we close FY18.
I understand that, but the impact through the P&L in FY18 is only 200 crores, right?
Yeah. So 797 positive and 1,000...
Sandeep, I'll take it offline there. I'll take it offline. So, Rajiv, the other question was, on the SME target segment. If I look at last 2 or 3 years, the turnover threshold has gone down from, about 25 crores to 10 or 12 crores right now.
Yes.
So, do you see this number going down further? That's first part of my question. Second is, how competitive is this space, that 10, 12 crores kind of turnover SMEs?
So see, the reason that number has been going down is as we have expanded geography. So basically, if you go outside of 100 cities, 60 cities plus, this number is 5-6 crores.
Fair.
Okay, so this number is not diluting the segment in tier 1, or it's about its contribution of the tier 2 market today would be 50% now. And tier 2 is defined as
more than 15 markets.
15 markets is tier 2. And tier 3 will be 60 plus. 60 plus contribution is now 40% of our SME lending book, because that's really where lower leverage is, granularity is. So that's where we are quite comfortable doing even a 4 crore customer doing business with.
Sorry, you said 60% is outside of tier 1?
60 locations.
Oh, okay. Got it.
So that 10 to 12 crores is blended as a result of, we are now doing this business in 565 odd locations. Competitiveness, look, this is a pure risk business.
Yes.
To deviate from the risk, we see people at a hobby level come into the business and go away from this business because it looks on a piece of paper a high margin business and people lose money very quickly. So you have to, it's a pure risk business. We have run the same business at 15-16% growth. Last 7 quarters, it grew 42. So now, if you correlate this to the portfolio credit quality, you do see that business loan portfolio has moved back to 98.76%. Last year, same time was 98.5, and it is 2 years ago it was 98.69. So, and where we are seeing the portfolios could look like 98.9% current, at least from a flow standpoint. So you have to just run it like a risk business rather than a growth business, if I may just use that word.
And Rajiv, on the expected credit loss, how much of this is sort of objective versus subjective? Is there an element of subjectivity even, in the estimation of expected credit loss?
Yes. You have to back it up with empirical data. It becomes much more easier in the consumer business.
Retail business.
So retail business is very easy to predict. Millions of customers, flow rates, there's lots of empirical data. Starts to become more difficult in SME, is virtually impossible in commercial. I think that's really where, at one level, it's our view that RBI struggled with as we were engaging with them, that how do you build ECL models, because it has to be built on a client-wise basis. Not to say it can't be built, but the subjectivity rises as you transition from retail to SME to commercial. So there is degree of subjectivity.
And lastly, on, commodity financing, you've spoken about warehouse financing in the past. So, sort of just wanted to understand, because there is a thought that, the entire thing could become digital over next, sort of 3 to 4 years.
Today only 1% is dematted. Very, very small. We are very slowly putting our arms around. It's 130 odd crore portfolio as part of our in the business. We have invested in the last 2 years in the teams, but we still don't have the confidence to grow it. It's Jira or soft. We are still figuring out, but yes, as the business gets dematted, opportunity is very large. We are learning the business.
Perfect. Yeah, thanks a ton for your answers.
Sorry, because I was saying it completes our rural strategy for us as a company, so that's really the intent and the opportunity in the longer term.
And it would be agri-commodities or non-agri commodities as well?
Right now it's only agri-commodities. As I said, it's very small. It's 130 odd crore portfolio. So we are testing. That's all I would say.
Cool. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Roshan Chutke from ICICI Prudential. Please go ahead.
I just wanted to understand this. Your 89 bps of standard asset provisioning will increase or decrease based on changes in the product mix, as well as it's also reflective of whether the product asset quality is worsening or improving, right? If 89 bps increases, then it's a worsening of portfolio provided the mix is the same. Is that a fair understanding?
That's correct. That's probably correct.
Probably.
So, because what may happen is the portfolio quality may not change at all. But as you have your customer aging over a period of time, more a customer will go into 1 and 2 and hence requiring more provision.
So it is two. One is product mix and another is the stability of the portfolio. Stability remains exactly the way it is hypothetically, and mix changes, you will still see movement. Mix changes to favorable, but stability reduces, you could see movement. So, welcome to Ind-AS, all of you.
And the other question, the same question that the earlier caller was asking, right? You have this 797 crores of movement in the last 2 years in this the subvention income that you earned, right?
Yeah.
Now, whereas for the last 1 year it is about 200 crores odd.
Yeah.
How do the two reconcile? So how do I understand this?
797 crores, first of all, is not only subvention, it has processing fees as well as cost of acquiring business.
It's a net number.
It's a net number. It has number across businesses, consumer durable to personal loan to mortgages and so on and so forth. It's accumulation of last 5-6 years of business that we have done. That you're seeing as 797 crores.
You should repeat it because there was a previous question. If you go to slide 19, you see it has impact on account of amortization of upfront fees, interest subsidy, minus cost of acquisition. So some prior he was also asking that is there subjectivity even in acquisition cost? There can be subjectivity even in acquisition costs. That you may say this is directly related to cost of acquiring. and you may say it is not. Is a salesperson effort directly linear to acquisition done? I can argue it is. Sandeep can argue it is not. So it leaves, even in cost amortization, there is a degree of subjectivity that will emerge as a result of Ind-AS. I think balance sheet disclosures will solve for it partially, so it's important we focus on it that it's three lines. 796 crores is not, 797 is not subvention. It's a net number. Subvention could be higher, processing fee could be higher, loan acquisition could still be higher. So it's a net number.
And as the balance sheet is growing for us, this number will keep moving up unless until we make significant movement in the portfolio mix.
Yes.
But if you can just explain how does this compare with the FY18 number? So the same number corresponding to FY18 would be what?
The FY18 number would be 797 plus the full year impact of 189 crores.
Yeah.
So that will be the closing number as on 31st of March. So you have to shuffle between slide number 19 and slide number 15. 197 crores for last full year and one-time impact as of 31st of March 2017 of 797. Put together is the balance as on 31st of March 2017.
74 minus 2496 is the differential plus 797. Yeah. That's the point you make. Yeah.
Okay. And just to understand this, now if coming to slide 15, so this 186 crores is for the first quarter. Now you will have a similar number or maybe slightly lower number for Q3. But by the time Q3 arrives, 186 must have run down.
That's correct. Yeah.
That's absolutely correct.
But for the year end, you came up with this number of 197. Is that so? That's the understanding. The understanding is right now.
We're in complete control of Ind-AS.
And if you did not grow, you will empty the bucket. So you for 2 quarters you may not realize you will realize the top line growth is slowing down, but you may not realize the P&L growth may not slow down. 2 quarters down the line, you may realize that. That's the point that we're trying to respond to earlier respondent as well.
Sure. Thank you so much, sir. That's all from my side.
Thank you. The next question is from the line of Preeti RS from UTI Mutual Fund. Please go ahead.
Yeah, thanks for the opportunity and congratulations to the team. So my question is on the two-wheeler segment business.
Yeah.
So we have seen Bajaj Auto becoming aggressive in the domestic market, and it's also clear from some of the comments in the annual report that competition has just started to become intense. So how has our participation changed, or let's say before and after this, and has the subvention scheme particularly has changed because our partner is aggressive? And also, since we don't have this data point in the presentation, the financial penetration or the market share in Bajaj Auto, has it increased given that we are probably 90% market share in Bajaj Auto financing?
So if you just go to the executive summary, I'll tell you that slide 10. So one, they don't offer subvention, very little. They do it as a promotion play. Essentially entire money is charged from the customer. That's been the construct of the business in general. In a promotion period, they may run subvention which are not material in nature. Two, if you see slide 10, 34% of their of Bajaj Auto's domestic sales is contributed by us. Right. This number has remained between 30, 32, 34% on an ongoing basis for the last I remember now 10, 11 years. Between 28% to 32, 33% is really where I would say in the last 10 years you've seen this. Now which means at an underlying level, if their Bajaj Auto's volume move because we are a captive, we will be positively, we will benefit from it. If Bajaj Auto's numbers are not moving, this team essentially only does captive or we only do captive, they would not see. So it's a tailwind for us as Bajaj Auto gets more aggressive, clearly reflecting in their, as per the Automobile Association, the April data, May data and June data should be a tailwind for us. On three-wheeler, we are 33% of Bajaj Auto's three-wheeler business. Three-wheeler is a bigger tailwind that Bajaj Auto is seeing. These are two separate teams within the there's a separate two-wheeler financing business and there's a separate three-wheeler financing business, and we run a reasonably efficient business to seize the tailwind. Except the two-wheeler business has actually, if I correlate this to portfolio quality, as the contribution of three-wheeler grows, we'll probably at a point in time, it's a smaller portfolio versus the two-wheeler, we'll probably strip in portfolio quality, two-wheeler and three-wheeler separately at a point in time, because that is causing the part of the credit quality to be yellow. I must make that point separately. Because if the mix changes, it changes the color. Three-wheeler customer is a SME or a below mass SME customer versus a two-wheeler customer who is a different customer. So, but we have tailwinds as a result of Bajaj Auto's growing market share.
So then it would be fair to assume that we are not taking more P&L or the balance sheet risk going forward just because the partner is aggressive.
Look, it is no. Okay. So, look, I've run the company for the last 11 years. It's on a pure arm's length basis. They never insist on what we should do and who we should acquire and not acquire. They've never insisted ever. So it remains purely on arm's length basis. We take the risk. If it is at 87.6% today, we are responsible for it, not they. If it became 85.88, we were responsible for it, not them. So that so it's on pure arm's length, and we run the business that way. Lastly, its contribution to the balance sheet is now at 7%.
Okay.
Okay. So and my view would be, my guidance would be, it will probably come down to 5-6% ending the year. Not because they are not growing, they are growing, but overall they are competing with 24 different lines of businesses who are growing. So their contribution will look more like 5%, which means they cannot impact the. No single business can actually impact the company. That's our orientation and granularity strategy. Definitely not them.
Sure. So this is definitely reassuring. Thank you. Good luck.
Thank you. The next question is from the line of Bharat Shah from ASK Investments. Please go ahead.
Yes, Bharat.
Yeah, Rajiv, no question. Hearty congratulations to you and your team.
Thank you.
It's one thing to get growth right and the physicality of the numbers right, but it is quite another to get the quality of the numbers right. In terms of the credit losses, in terms of the operating leverage, the sheer growth, and maintaining the balance of all of the qualitative aspects. That's remarkable. Congratulations.
Thank you. We are committed to pursue that, Bharat, all our investors, and keep building the business out. Thank you.
Fantastic.
Thank you. Thank you very much.
Thank you. Ladies and gentlemen, we take the last question from the line of Nitesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. So on the housing finance, the profitability for this quarter looks a bit muted. Any reason for that? That is first question. Second question on the fee income, what quantum of fee you have originated from life insurance, and how has been the growth on a YOY basis in that line item? And lastly, on the ECL, which product line has had the maximum impact of on ECL, and which product line has the least impact on your ECL numbers?
Look, start with BHFL. I'm just looking for the results. So look, we didn't do detailed results. So fundamentally, you have to look at it this way, that their GP itself was 6 crores. They are building out the business. There are no assets there. Out of 7,272 crores of assets, mortgage is a AR business, stroke AUM business. in the year or the month in which you acquire or the quarter that you acquire, you actually are investing that entire money mostly on general provision. So GP, pre-GP is really the way to look at it, because especially within that, the LGD will really be net really low. So as we move ahead, it's a young business. You will see very similar numbers play out on a standalone BHFL for maybe for the current year is what I would say. From next year onwards, you start to see some profitability emerge. It's as I was telling investors in the or shareholders in the AGM as well, that these are all incubations. Please be patient in they going out and building a rightful model and building the business out. Your second question was on insurance. We work with 9 insurance companies across life insurance, general insurance, health insurance, originate a lot of insurance across life, general and health, run our insurance income on an arm's length basis that they publish for, that they offer to all their partners. What number it is a bilateral conversation between us and the insurance distributor, but our captive play is less than 35-40%. Less 60% is across non-captive, and it's all based on arm's length. Third, you had a question on ECL. Sorry,
which product has maximum impact?
Which product has
maximum impact? Which has the least impact?
Mortgages. I mean, loans against security is the least impact, right?
Yeah. Commercial balance sheet for us
in that.
Yeah, commercial balance sheet including loan against securities, because empirically we have not seen any losses in that, has seen significant reduction in the provisioning, whereas other parts of business have seen some level of increase.
So, going back to the point that we were making earlier, the two-wheeler, if you see this business, it will start to become, you have to start to correlate the conversation with the portfolio quality data that we share. Because this is now not about 90 days. So in a way, two-wheeler, three-wheeler portfolio would have a disproportionately higher share of provisioning that has come into the numbers, because they have, 12% of the 30 plus is 6%. So it's stage 1 technically, stage 2. So that's how you'll have to start to read slide 26, 27, 28 to the earlier question even Nischint was asking, that these numbers move, loan loss provision will start to move. These numbers drop, empirically, the loan loss provisions will start to drop. They will start to correlate much more closely to P&L. Otherwise, it need not play into P&L the way things are organized today. We've always run the business, parts of it, if I give you example, and that's why we saw no impact of transition from 180 to 150 to 120 to 90, because in many of our businesses at 60 days past due, we charge off 70%. So it is flowing through. Otherwise, the impact on such a large balance sheet of ECL could have been still higher. I must make that point importantly. Whatever small, now it's less than 200 odd crore number on a 94,000 crore balance sheet. So the P&L was fully costed, now even the balance sheet is fully costed. So that's really how we would articulate.
Yeah. Sure. Just to ask one more question on housing finance, given the interest rate scenario on the liability side and competition on the asset side, is there any change in strategy in that business? And secondly, what percentage of your disbursement comes from balance transfer from an existing lender?
Around 50% comes from balance transfer. I would re-articulate, they're a baby off the ground, wait for the baby to walk. We'll stay focused on mass affluent customer, no affordable housing, remain, we are now doing business in only 45 cities in India. We will it's a AAA rated business, which means allows us to target a AAA or a prime client. It's as a result of DHFL transition, our overall cost of funds for the mortgage business has dropped because the bond markets price NBFC separately and HFC separately. Apple for apple, same day BFL goes into the market, we see borrowing cost goes for 100 crore bond market borrowing for an NCD. If we get at X coupon, we get at 15 to 20 basis points lower coupon, which means it's beneficial to transition this business and run it as part of HFC. So net we are quite excited, but we'll have to just be patient.
Thank you, sir. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Karan Singh for closing comments.
On behalf of JM Financial, I would like to thank Mr. Rajiv Jain and the senior management team of Bajaj Finance and all the participants for joining us on the call today. Thank you and goodbye.
Thank you. Thank you all. Thank you.